The market is not your enemy. This is the first illusion you must shatter. When you lose money, when a trade moves against you with savage precision, when you watch your carefully constructed position collapse in real time, your mind instinctively searches for something to blame. The market becomes that adversary, but this interpretation is fundamentally wrong, and it costs you far more than capital. The market is nothing more than an aggregation of human decisions rendered into price action. It has no memory, no malice, no consciousness. It simply is. The enemy you face, the force that will either forge you into an exceptional trader or grind you into dust, resides entirely within you. It is the untamed chaos of your emotional architecture. And until you understand this with absolute clarity, you will never achieve consistent profitability. Consider the anatomy of a typical losing trade. You enter a position based on what you believe is sound analysis. The thesis is clear, the setup is clean, the risk is defined. Then something shifts. The price moves in the opposite direction, not dramatically at first, but enough to trigger that initial spark of discomfort. This is the critical moment, the threshold where everything that follows is determined. In this space between stimulus and response, your emotional system activates before your rational mind can intervene. Your amygdala, that ancient structure designed to detect threats in your environment, cannot distinguish between a predator in the wilderness and a red candle on your screen. To your nervous system, losing money triggers the same biological alarm as physical danger. Your heart rate elevates, cortisol floods your bloodstream, your breathing becomes shallow. These physiological responses are not weaknesses or character flaws. They are the evolutionary inheritance of a brain designed for survival in a world where immediate threats required immediate action. But the market is not that world. The market demands something your biology was never optimized for: patient, rational, emotionally detached decision-making in the face of uncertainty and potential loss. What happens next is predictable with almost mathematical precision. As the trade continues to move against you, your emotional intensity escalates. You begin to negotiate with reality. Perhaps this is just temporary volatility. Perhaps the technical level will hold. Perhaps the news that drove this move will be revised or reinterpreted. This negotiation is not analysis. It is your psychological immune system attempting to protect your ego from the pain of being wrong. The human mind has an extraordinary capacity for self-deception when confronted with information that contradicts its beliefs. Cognitive dissonance, that uncomfortable tension between what you believe and what reality presents, becomes unbearable. Your mind will perform elaborate gymnastics to resolve this tension, and the path of least resistance is always to distort reality rather than admit error. You hold the position. You tell yourself you are being patient, disciplined, convicted in your analysis. But beneath this narrative, fear has already metastasized into something more dangerous: hope. Not the productive optimism of a well-reasoned thesis, but the desperate, ungrounded hope of someone who cannot accept loss. The position continues to deteriorate. Your carefully defined risk parameters, those levels you swore you would honor before entering the trade, now seem arbitrary and overly conservative. After all, you reason, the market is irrational in the short term. If you just give this trade more room, it will come back. This is the moment where the psychological rot becomes terminal. You are no longer trading your system or your analysis. You are trading your emotions, specifically your inability to accept the reality that this trade has failed. The stop loss that would have preserved your capital, and more importantly, your psychological equilibrium, gets moved. Then it gets moved again. The loss that would have been manageable, even trivial in the context of a disciplined risk management framework, becomes catastrophic. When you finally exit, either because the pain becomes literally unbearable or because you have exhausted your available capital, you are not the same trader who entered that position. You are damaged. Your confidence is shattered. Your account is wounded. And worst of all, you have just encoded a deeply pathological behavior pattern into your neural architecture. You have taught yourself that discipline is optional, that rules are negotiable, that emotional comfort matters more than systematic execution. This cycle repeats with variations across every trader who fails, and the failure rate in this field is staggering. Some estimates suggest that 90% or more of retail traders lose money consistently. These are not stupid people. They are not lazy or uneducated. Many are highly intelligent, successful in other domains, capable of complex analytical thinking. Yet they fail in the market because intelligence alone is not sufficient. What separates the small minority who achieve consistent profitability from the vast majority who do not is not superior market knowledge or access to better information. It is emotional mastery. It is the capacity to feel fear, greed, hope, and euphoria, and still execute your system with robotic precision. It is the ability to take a loss without it meaning anything about your worth as a trader or as a person. It is the discipline to follow your rules even when every fiber of your being screams at you to do otherwise. The path to this mastery begins with brutal self-honesty. You must become a forensic investigator of your own psychology. Every trade, winning or losing, should be examined not just for what happened in the market, but for what happened in your mind. Where did you feel fear? At what point did confidence become arrogance? When did you know you should exit but instead rationalized holding? This is uncomfortable work. Most people avoid it because it requires confronting aspects of yourself that are not flattering. It means admitting that you are not as rational as you believe, that you are subject to the same cognitive biases and emotional hijackings as everyone else, that your self-image as a disciplined logical thinker may be largely illusory, but this discomfort is the price of transformation. You cannot fix what you will not acknowledge. Once you begin to map your emotional landscape with precision, you can start to build structures that protect you from yourself. This is what genuine trading psychology is about. It is not positive thinking or visualization or affirmations, though these may have peripheral value. It is about creating systems that function independently of your emotional state. Your trading rules, your entry criteria, your exit protocols, your position sizing formulas, all of these must be defined with such clarity that emotional interpretation becomes impossible. If you allow any ambiguity, your emotions will exploit that space. They will find the gap in your system and pour through it like water through a crack. The rule must be absolute. When condition X occurs, I take action Y, no exceptions. No context-dependent adjustments. No special circumstances. The brilliance of a rule-based system is not that it produces perfect trades. It is that it removes the burden of decision-making from the moment of maximum emotional intensity. You are not trying to be rational when fear or greed are surging through your nervous system. You are simply executing a protocol you designed when you were calm and clear-headed. But even the most robust system will be tested by the fundamental uncertainty that defines market participation. You can never know with certainty what will happen next. Every trade is a probabilistic bet, and even trades with high probability of success will fail with some frequency. This irreducible uncertainty is where many traders psychologically fracture. The human mind craves certainty. It wants to believe that if you do enough analysis, use the right indicators, follow the right methodology, you can eliminate risk and guarantee success. This belief is not just wrong. It is antithetical to the nature of trading itself. The market is a complex adaptive system influenced by millions of participants, each with their own information, incentives, and emotional states, all interacting in ways that generate emergent behavior that cannot be predicted with precision. To demand certainty in this environment is to fundamentally misunderstand what you are participating in. The mature trader does not seek to eliminate uncertainty. They seek to become comfortable operating within it. This comfort is cultivated through repeated exposure and through a fundamental shift in how you relate to outcomes. Most traders are outcome-oriented. They judge themselves based on whether individual trades are winners or losers. This creates a brittle psychology because even a well-executed trade can lose, and even a poorly executed trade can win. The market will sometimes reward your mistakes and punish your discipline, at least in the short term. If you derive your sense of competence from outcomes, you will be perpetually destabilized by this randomness. The alternative is to become process-oriented. You judge yourself based on whether you followed your system, honored your rules, and executed your plan. The outcome of any individual trade becomes almost irrelevant. What matters is whether you are consistently doing what you committed to doing. This shift in orientation is profoundly liberating. It means that you can take a loss and walk away with your psychological equilibrium intact, even enhanced, because you proved to yourself that you can honor discipline in the face of discomfort. Over time, if your system has a genuine edge, this process-focused approach will produce profitable results. But the profitability becomes almost a byproduct of the psychological transformation rather than the primary goal. The emotions themselves, those feelings you may have been trying to suppress or eliminate, are not actually the problem. Fear is useful. It signals risk and keeps you from taking reckless positions. Greed, properly channeled, provides motivation and keeps you engaged in the pursuit of opportunity. Even hope, in its healthier forms, sustains you through inevitable drawdowns. The problem is not the emotions. It is the unconscious reactive patterns they trigger. It is when fear bypasses your rational faculties and causes you to exit a position prematurely. It is when greed causes you to overtrade or oversize positions beyond your risk tolerance. It is when hope prevents you from accepting reality and cutting losses. The goal is not to become emotionless, which is neither possible nor desirable. The goal is to create space between the emotion and the action, to feel what you feel but choose your response based on your system rather than your impulse. This space is created through what might be called metacognitive awareness, the ability to observe your own thinking in real time. When you feel the urge to move a stop loss or double down on a losing position, you learn to notice that urge without immediately acting on it. You create a gap, a pause, in which you can ask yourself whether this action aligns with your system or whether it is an emotional reaction you will regret. This capacity for self-observation is strengthened through practice, through meditation, or mindfulness training, through journaling, through any activity that builds your ability to watch your own mental processes, as if from the outside. The more you develop this skill, the more you realize that you are not your thoughts or your emotions. You are the awareness that experiences them. And from that place of awareness, you have choice. The market will never stop testing you. It will present scenarios specifically designed to exploit your weaknesses. If you struggle with fear, it will whipsaw you with volatility. If you are prone to overconfidence, it will hand you a series of easy wins before delivering a devastating loss. If you have difficulty accepting being wrong, it will give you positions that almost work, that come within ticks of your target before reversing catastrophically. This is not because the market is conscious or malicious. It is because the market is an arena where human psychology plays out at scale, and all the patterns that cause most people to fail are embedded in price action itself. The market rewards the rare behaviors that most people cannot sustain: patience when others panic, aggression when others hesitate, discipline when others rationalize, acceptance of loss when others cling to denial. To succeed, you must become psychologically antithetical to the majority. You must develop traits that feel unnatural, uncomfortable, counterintuitive. This is why so few succeed. Not because the technical aspects of trading are impossibly complex, but because the psychological transformation required is something most people are unwilling or unable to undergo. If you are still reading this, still engaged with this exploration, it means some part of you recognizes the truth in these words. You have felt these patterns in yourself. You have experienced the frustration of knowing what you should do, but finding yourself incapable of doing it consistently. This recognition is the beginning. Understanding your emotional architecture, accepting that these challenges are universal rather than unique to you, committing to the slow, deliberate work of building genuine psychological discipline, this is the foundation upon which sustainable trading success is built. The market will not destroy you. Your undisciplined emotions will destroy you. But with awareness, with systems, with relentless practice and honest self-examination, you can transform those emotions from your greatest liability into a source of information and even strength. The trader you need to become is not someone who feels nothing. It is someone who feels everything but acts from principle rather than impulse. Master this, and the market becomes not an adversary to fear, but an environment where your psychological development directly translates into financial reward.